In this opportunity, we are going to talk about valuation with multiples. Our previous videos focused on discounted cash flow as the prevalent method for firm valuation. Multiples, also called comparables, are an alternative method which is almost as popular as discounted cash flows. Some typical multiple. What is a multiple? A multiple is just a fraction, a ratio that reflects the relationship between the value of the company and a particular characteristic of that company. And the value of the company is based on the stock price and also the value of the bonds of the company in the capital markets. Here we have some examples. In the first table here, we see enterprise value divided by, for instance, EBIT, earnings before interest and taxes, or EBITDA, or sales, etc. And by enterprise value, we mean the total value of the firm, including both the equity and the liabilities. In the second table, we see market capitalization divided also by several items, like a net income, or fresh cash flow to equity, or earnings before taxes. And by market capitalization, we mean the total equity value of the company, meaning the total value of the shares of the company. In the third table, we see a stock price, and now we mean the value of a single share of stock. The stock price divided by earnings per share, or dividends per share, etc. And finally, in the last table, we have enterprise value divided by, for instance, clients, or square meters, or units sold, or patents. These are ratios which are very specific to a particular industry. For instance, enterprise value divided by clients is very useful, for example, to value a magazine company, a company that sells magazines, or a telephone company, because the company is more valuable the more clients it has. Or enterprise value divided by square meters, which is a ratio which is typical when you want to value shopping malls. Or enterprise value divided by patents, which is very common when we want to value pharmaceutical companies. Actually, discounted cash flow and multiples are different measures. Discounted cash flow, or present value, delivers value. Why? Because the discounted cash flow is based on the expectations of the person who is doing the valuation. So it's a subjective measure that gives us the value for the person who is doing the valuation. Whereas the multiples have nothing to do with the expectations of the person who is doing the valuation, or the analyst. Multiples are based on prices, on market prices. So present value and discounted cash flow gives us value, whereas multiples deliver price. However, for any investment decision, we need both. We need value and price. For instance, if we are considering buying a particular share of stock in the stock market, and we see that the value, according to our expectation, is bigger than the market price, then we have a good opportunity to buy. Okay? We will be buying cheap, and vice versa. If our value, the value according to our expectations, is less than the price, we will not buy. We will be sellers. Then, multiples are really not a substitute for discounted cash flows. They are different measures. However, both are usually used at the same time. In the same valuation, we use both methodologies. And the reason is that we tend to use multiples as a way to check the robustness and consistency of a discounted cash flow valuation. For instance, if we find that the multiples valuation differs significantly from the discounted cash flow, then a couple of things might happen. First, could be that the companies that we used as a reference, the companies that we used to calculate the multiples, are really not comparable to the firm we are valuing. Then we chose the wrong multiples. That is a possibility. Another possibility is that the assumptions that we made for the discounted cash flow are wrong. Well, say that you reflect about this and you decide that no, that the multiples are okay and the assumptions for the discounted cash flow is okay as well. Then the second possibility is that actually value is different from price. Okay? For instance, it could be that in our discounted cash flow, we found that the value of the company is bigger than the value given in the market through the multiples. Then we have a good purchasing opportunity, and vice versa. If our value is less than the market price, of course, the company is to expect. The company for us is value. The value of the company is less than the market value, and we should not be buyers but sellers. There are other multiples which are known as transaction multiples. These are multiples that correspond to recent acquisitions, and by this we mean cases in which a company is acquired by another company, so it's completely controlled. It will be completely controlled by another company. So in this case, this is a case which is different from a simple stock transaction, because when you acquire the control of another company, you are going to manage this company, and somehow you are going to transfer some know-how to this company that you are purchasing. Transaction multiples are popular in acquisitions. Usually when people are valuing the acquisition of another company, they tend to use sometimes these transaction multiples. The problems with transaction multiples is that they somehow reflect the acquirer's expected synergies, or at least part of the acquirer's expected synergies. Let me explain. When someone is considering taking control of another company, it's because supposedly the buyer expects to add value to this company which is being acquired. And in the negotiation process, the acquirer is usually willing to pay a price above the market price. So the price that is reflected in the transaction multiple reflects this slightly or higher price which is paid by the buyer. And this higher price reflects parts, includes part of the synergies of the acquirer. So this price implied by the transaction multiple tends to be upward biased. And of course, if we use this as a reference and say that we are also acquiring a company, and we use this as a reference, and then we decide to add our own synergies, probably we are overestimating the synergies and we are overestimating the value of the company. So in conclusion, transaction multiples are wrong because they overestimate the value of the firm to be acquired. And in conclusion, we shouldn't use transaction multiples. Let's conclude. Multiples are a popular method to value firms. However, they are not really equivalent to discounted cash flows. Multiples reflect price, whereas discounted cash flows reflect value. Multiples are actually useful to verify the validity of a discounted cash flow valuation, the robustness and consistency of the valuation. And finally, transaction multiples must be avoided because they tend to include synergies, and we will overestimate the value of the firm that we are considering. And this is all I wanted to share with you in this opportunity.